Aloha everyone! Welcome to 2023. I'm Robert Retail Real Estate Agent with Better Life Realty. I'm also a real estate investing specialist. Today I'm going to go over a special video with you on Las Vegas real estate current state of the market and will mortgage rates drop to lower levels again? And I'm going to make the case why now can still be a good time to buy or sell. In my previous video, I talked about how the Fed is committed to bring inflation rate to 2%. So to do that, it needs to increase interest rates. And just a reminder, higher Fed interest rate means it gets more expensive to borrow money in financing a car, even a home, or even to purchase something on a credit card. When interest rates are higher, the availability of money in the financial system also tends to shrink, another factor making it more expensive to borrow. That means the Fed is trying to discourage people spending, especially on credit or financing. In my previous video, I also talked about how we are in a market correction, not a market crash. In the next couple slides for the Las Vegas market trends of 2021 and 2022, you begin to see housing values is already gradually decreasing. Now, because the Fed is committed to bring inflation rate to 2%, they'll continue to raise interest rates, meaning I also predicted housing values will likely and continue to gradually incrementally decrease in 2023. I also predicted mortgage rates likely to gradually increase as well in 2023. But in this video, I'll make the case that there is a possibility that mortgage rates may go down. For the Las Vegas real estate market trends, I took the data from the Las Vegas Realtors Association, and as you can see here, the blue line is represented median price units sold for single family homes in 2021. And the red or orange line, as you can see here, is the median price units sold single family in 2022. As you can see here, in 2021, you can see they gradually increase. And in 2022, the beginning of the year is gradually increasing and closer to the mid June to December, where you started to see median price units sold started to gradually decrease. And that's the market trends for Las Vegas. Now for the median price for condo townhouse units sold, blue line is for 2021, orange or red line is for 2022. As you can see here, similar to single family homes, the median price for condo townhouse units sold in 2021 started to gradually increase. In 2022, beginning of the year, it started to gradually increase, but sometime starting back in May, as you can see there, back in May and all the way through December, the median price units sold for condo townhouse units started to decrease as well. For single family time on market 30 days or less, again, blue line is for 2021, orange or red line is for 2022. As you can see there, in 2021, you can see there was more homes started to sell at 30 days or less. Now, starting in 2022, beginning of the year, from to the mid of the year in 2022, that's when homes were still being sold more than 30 days or less. Now, they started to decline. If you can see here, the trend started to decline around August, between July and August, up until the end of the year. By the end of the year, we were below the 50% mark. So that means by the end of the year in 2022, most homes were being sold more than 30 days. So as you can see there, there's a trend. For the condo townhouse time on market 30 days or less, blue line 2021, orange or red line is 2022. Similar to the single family homes, the condo townhouse unit market trends in 2021, as you can see there, it's steadily, most homes being sold were 30 days or less. And in 2022, as you can see there, beginning of the year to at least mid of the year, at least by May, the homes started to sell at 30 days or less, but they started to decline, as you can see there. By the end of the year, we broke past 50% around November, December. So by the end of the year, similar to single family homes, the condo townhouse most homes on market were being sold more than 30 days. So if the Fed is committed to bring inflation back to 2% by raising interest rates, will we see 5% mortgage rates again? Now, what is inflation? Inflation means there's too many dollars chasing too few goods. That means there's a lot of demand, not a lot to go around in supply. So if it continues that route, you can call what it considers hyperinflation. Now, not getting too critical in economics here, but just to let you know, when Fed steps in to raise interest rates, their goal is trying to bring inflation down. Because when they raise interest rates, they're trying to discourage buyers from buying that product. So that way, there's less demand for that product because buyers won't be able to afford because of the high interest rates. So it'll lower the demand in hopes to lower the demand and that way to bring down inflation. Now, in this chart, inflation drives mortgage rates. Now, just to give you a broad overview, I just don't want to go in detail about economics, but I just want to introduce to you why we may be considered in a normal market. We just got used to because we were low interest rates for so long. Anyone remember how we got to low interest rates? Is because remember the financial meltdown back in 2008? What from that 2008 meltdown, the Fed had to introduce money in the money supply. So that means to encourage spending, the Fed had to lower interest rates. That's why it took years for us to recover from that financial meltdown. That's why low interest rates stayed with us for years, and because it stayed out for years, we thought that was normal. So now, what caused inflation was when we were in 2020, where during the pandemic. Remember when we were in a lockdown? Not so much of us were working. Remember in that lockdown, not the production, but we were still in demand. We were actually buying products, but not a lot in supply because nobody was making anything during that time. Does it make sense? So it bogged the supply down as well. So when we got back to work, or when the economy after the when we opened up, cities opened up and all those, now we still got a lot of demand and supply couldn't catch up. So again, a lot of demand for certain products, certain items. So those prices had to go up. As you can see there, because inflation was going up, mortgage rates was also going up. So as you can see here, the historicals. Now, to make the argument, we may see mortgage rates go down because if the Fed raising interest rates to make inflation go down, if inflation goes down, remember, mortgage rates can go down. That's why I'm making the case we may see if inflation goes down, we may see a case where mortgage rates may also go down. So when will we see inflation peak? Well, according to this chart, during 2021, there was actually a drop in the core consumer price index. That was the inflation. So we actually saw inflation shot up in October of 2021 at 6%. Now, the Fed were still tracking and monitoring the inflation. And those indicators were lagging. And I'll talk about lagging indicators a little bit later. But those indicators were lagging. So they didn't started to realize to take action until March of 2022, when they started to realize, hey, this inflation is not transitory as they thought. So they raised a couple of interest rates for a couple of percentage points. As you can see there, that's where you see a dip in the core consumer price index in March. Now, because it wasn't transitory as they thought, those lagging indicators still indicated, hey, inflation was still going up. So they started to have to continue to raise interest rates. As you can see there, they did several bouts of raising interest rates during 2022. So back in October 2022, as you can see there, core consumer price index dropped to 3%. And that's where we started also noticing when mortgage rates started to increase because inflation rate was increasing. At October 2022 level, we started noticing with the consumer price index going down, we also started noticing a fluctuation in the mortgage rates as well, from high of 7% to low as 5%. So we started to see that fluctuation. So as the Fed continued to raise interest rates, And since if it's not sustainable at that level, and we might also see a fluctuation in the mortgage rates as well. So when will we see inflation peak? Well, even the Fed is going by indicators that are lagging. I talked about lagging indicators a little bit earlier. So to explain what is lagging indicators, I'm using this picture as a roller coaster because the economy is moving along, but by the time we get the indicators, say for example, what's going on in the market is in the front of the roller coaster, but you're getting the indicators at the back end of the roller coaster. So even though if inflation started going down during that time, we still might feeling the inflation still going up. As you can see there, that's why I use this picture as a roller coaster to explain why we are those lagging indicators. Was taking some time for us to look at what's really going on in the market. Now, what I'll also recommend you do is watch Chairman Powell's press conference in December 14, 2022 in YouTube. But here's a transcript of what he said in that press conference. He said, the US economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters of this year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer run normal growth rate. He went on to say inflation remains well above our longer run goal of 2%. Over the 12 months ending in October, total PCE price rose 6%. Excluding the volatile food and energy categories, core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases, but it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressure remains evident across the broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year, 2.5% in 2024, and 2.1% in 2025. Participants continue to see risk in inflation as weighted to the upside. He also said, despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance the expectations of higher inflation will become entrenched. Now, Chair Powell went on to say, and there, the strong view of the committee is that we'll need to stay there, until we're really confident that inflation is coming down in a sustained way. And we think that will be some time. Now, why do I say that? If you look at, you can break inflation down into three sort of buckets. The first is goods inflation, and we see now, as we've been expecting really for a year and a half, that supply conditions would get better. And ultimately, supply chains get fixed and demand settles down a little bit and maybe goes back to services a little bit. And we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up, actually. As rents expire and have to be renewed, they're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the rate for new leases is coming down. So once we work our way through the backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE Core Inflation Index, is non housing related core services. And that's really a function of the labor market largely. The biggest cost by far in the fact sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high. Vacancies are quite elevated, and really, there's an imbalance in the labor market between supply and demand. So, that part of it, which is the biggest part, is likely to take a substantial period to get down. And he went on to say the goods inflation turned pretty quickly now after not turning at all for a year and a half. Now it seems to be turning. But there's an expectation, really, that the services inflation will not move down so quickly. So that we'll have to stay at it, so that we may have to raise rates higher to get to where we want to go. And that's really why we are writing down those high rates and why we're expecting that they'll have to remain high for a time. So, how does central banks affect interest rates? The Fed sets target interest rates at which banks lend to each other overnight in order to maintain reserve requirements. This is known as the Fed funds rate. The Fed also sets the discount rate, the interest rate at which banks can borrow directly from the central bank. If the Fed raises interest rates, it increases the cost of borrowing, making both credit and investment more expensive. This can be done to slow an overheated economy. If the Fed lower rates, it makes borrowing cheaper, which encourages spending on credit and investment. This can be done to help stimulate a stagnant economy. So let me give you a brief overview of how the financial system works, because this will give you an understanding why we might see mortgage rates to decline as well. But I would suggest to learn more about the financial system. There's a documentary movie I would suggest you watch, Inside Job, published 2010, directed by Mark Charles Ferguson, narrated by Matt Damon, because it is about the global economic crisis of 2008. So that way you can understand how the financial system works as well. Now, when we borrow money, we're actually borrowing from lenders, right? Servicers. They lend money out for, in the forms of when you're borrowing credit cards, uh, buying a car, getting a car loan, home loan, student loans, things like those. Now, these lender servicers get their fees when they transfer or sell these loans to investment banks. Now, these investment banks packages these loans up and sell it to investors around the world. So when you're paying your mortgage payments, you're not paying to lenders and servicers. You're actually going through the financial system to where you might be paying your mortgage payments to investors around the world. But the lenders or servicers will service your loan and they get the fees. I'll talk about a little bit more about that a little bit later. That way you get an understanding why we might see mortgage rates as well come down. Now, as you can see here, there's a 30-year mortgage rates versus the 10-year Treasury spread. They don't necessarily track each other, but as you can see here, within 35-year history, we see a normal spread between these two, between 1.75 basis point to 200 basis points. So basically 1.75% to 2% difference. So just recently, we just broke the 35 history average. As you can see here, current spread 300 basis points. So basically 3% difference between these two. So say for example, if your treasury spread is at 5%, your mortgage rate is at bond rate is at 4%, your mortgage rate is at 7%. So this, remember I went in my previous slide, I talked about how the loan is being sold to investors. So this spread right here, there's a lot of spread. Now, that means the bond is not that attractive to investors because once mortgage rates goes down, guess what people will do? They'll refinance, right? So now for the servicer, they want to hold the note as long as they can because that's where they get the fees. They collect fees. So if this high difference, the high interest rate, is not attractive to investors because they know there's a risk because it's not going to be that long because once mortgage rates drop, that's when people will refinance. So say for example, now to give you an example, that way you hopefully you do understand where this comes into play with the mortgage rates. Say for example, the homeowner gets a loan for 7%. Now, mortgager, the servicer, actually sells that loan to an investor. So technically, if you're looking at it, remember the financial system. Technically, the investor is lending the homeowner $500,000 for a 7% loan. The risk is they know that 7%, it's not that loan. It's not that attractive to the investor because once mortgage rates goes down, guess what the homeowner gonna do? They're gonna want to refinance to a lower rate. So that $500,000 loan from 7% to 5% loan if the mortgage rate goes down to 5% or lower. So that's the risk investors will take. So a higher percentage loan amount may not be as attractive to the investor because it's not going to stay that way for long when homeowners going to refinance it out of it. Does it make sense? And the mortgager, they want to hold the note as long as they can because they want to keep the service fees. So they collect the service fees out of that note. So that service fee is the servicing value of the note. The value of the note depends on the interest rates. The longer the servicer holds the note, the servicer can collect fees. So just gotta remember that in the financial system. So if history repeats itself, we see here historical data for 35 years, the normal point spread is 175 to 100 basis points. So even though the current spread right here, 300 basis points, when the Fed raises interest rates, they want to lower the inflation. So we may see during 2023 inflation start going down, and that way we might see mortgage rates to go down as well, going back to that normal spread. So with what's going on in the market today, now can still be a good time to buy or sell. That's right, now can still be a good time to buy or sell. So regardless of what market is doing, we will always have people selling or buying real estate. That's right, we will always have people selling or buying real estate in the market. Why? So there might be some extra motivation for them to sell or buy. So some of them, say for example, may have lost a job, relocating somewhere to where they got a job, household income changes, or say for example household size changes. Say for example their kids with a family, their kids turn to completed high school, they're going to college, so the parents are downsizing, looking to downsize their home. So this might be another opportunity where they might downsize or relocate, things like those. So there will always have people selling or buying real estate regardless of whatever's the market's doing. For those of the homeowners needing to sell, that you're motivated to sell, now can be a good time to sell. Now can it be a good time to sell. Remember that median single price unit sold, that market trends? As you can see here, just a reminder, the blue line was 2021, orange red line is for 2022. As you can see there, at December 2021, December 2022, the median single price actually was almost similar. So in 2021, remember in 2022, there was a increase, but at the end of the year, it almost went back down to almost the same level as December 2021. So we started to see median single price units sold, home values started to gradually been declining. So you don't want to wait to sell as your home values continue to decline. You want to sell now, that way you can get top dollar for your home. Now, in my previous video, I talked about how's the difference about buying for a home to live in as for home ownership versus buying a home for real estate investing. So the primary intention for home ownership is that you are making a long-term investment in you and your family's living lifestyles. That's right. It's an investment in you and your family's living lifestyle. Now, for real estate investing, you're investing for profit or income. There's totally big difference. Now, for home ownership, again, you are making a long-term investment in you and your family's living lifestyle. So there may be considered intrinsic value, and that just not the property value that you may have to look at when you're looking for a home. So some intrinsic value that only you can determine if the home is a good deal or not. Say, for example, if the home can provide that you live in your dream home where you can and your family can enjoy and start living a wonderful lifestyle, create memorable moments together, celebrate special occasions and holidays, living in a great neighborhood, enjoy the amenities around the neighborhood, meet your neighbors and make new friends, get involved in your neighborhood community. So if it meets certain criteria that you're looking for in a home, especially the location of the home, you might want to consider, hey, is that a best good value property to own for you and your family? So you're the one to have to determine if it's going to be a good deal meeting your intrinsic values. So if you find a home that meets your needs, why wait? Buy now. So here's an example of perfect opportunity in a house if you're looking for the numbers itself, not just the intrinsic values. Say for example, you found a home, $500,000 purchase price, 80% loan to value ratio. So if you bought the home in a year, right, where buyers were competing, they were actually overbidding each other, right? So buyers would even offer over $50,000 over asking price, no terms. So things like those that happened last year, they may not necessarily be in a market this year. Say for example, now you get to negotiate normal. As a buyer, because of the market downturn, now you'll have the opportunity to negotiate. Don't necessarily have to offer over asking price. So there is a buying opportunity right now because of the market. Now, you will also have to talk to your lender because to make it possible, remember, interest rates may go down, may go up. So if you're banking on going up in the future, but you don't want to lose the home because, again, here in this market, some people might be able to get that home that you want. So you want to bid too for that home. So talk to your lender. You might be eligible for the 2-1 buy down, which means you get your lock interest rates. Say for example, if your interest rate is at 7%, but say for example, sometime this year or next year or so, the interest rates go down, you can refinance. So that 2-1 buy down allows you to refinance later. So the first year you get to pay your mortgage at 5%. Does it make sense? And when it goes down to 5% is where you refinance. But you want to lock in your rates now. That way you can get the home that you want. So, but again, talk to your lender for your options. That way you see how you can qualify the home that you want for. Now, if you're still skeptical and you're not sure if the mortgage rate's going to go down or if it's going to continue to go up, ask your lender. There might be an option for you for a permanent buy down where you buy your rates now. You're locking your rates, buy your rates. That way you can pay a lower rates down the road. So again, you're paying interest rates up front. So, but talk to your lender, see what your options, because you don't want to lose the opportunity where you find a perfect home for you, meeting your intrinsic values. You want to start creating memories for your family in that home. So, talk to your lenders how you can get a loan for you to get that home. So it might be a buying opportunity because right now, as you know, the winter season is where even though the market's doing what it is, when everybody knows winter season usually a slowdown for real estate as well. So why wait till spring where everybody else comes into play? So that means if you wait for springtime, you're going to be competing with a lot of buyers as well. So just kind of reconsider that as well when you're looking to buy a home right now. Now, if you're still not ready to buy, you can still look for homes for sale that you want. That way you can lock in rent rates and lock in your right to purchase prices. That's right. We have a program for Better Than Rent program where you can look homes for sale, where you can currently rent until you're ready to buy, but you can lock in rent rates as well as lock in your right to purchase program. So, and you can buy anytime during your lease agreement with no obligation to buy. So If you're not ready to buy, contact me, ask me about our Better Than Rent Right to Purchase program. All right, now I'd like to hear it from you. What do you think the market's going to do? Because the information I provided, are you looking to buy or sell right now? Or are you still going to wait? I'd like to hear it from you, so please make sure you comment below and don't forget to click the like button and share. Make sure you share this information to your friends and family. Let them know there are opportunities out there regardless of the market's doing. All right, so make sure you also click the subscribe button. That way you don't miss any important information that I make for you. Happy house hunting, everyone!